Is it good morning? Hmm? Good morning, GPF members and GPF Facebook subscribers. Today's presentation will be done by myself. I am Smanga Selemeni, and the responsible for membership education and external communications at the GEPF. The presentation is going to focus on the pension reforms, what is known as the two-pot system, or what you normally refer to as early access to your pension. In terms of the house rules or how rules of engagement would plead with all those that are participating here that if you have a question, please post it on your Facebook comments on the GPF Facebook page, and at the later stage, we'll then respond to all those questions. The second announcement is that please note that we will be doing these presentations from time to time. However, you are still allowed to invite us either as a union or shop stewards or human resources practitioners in different government departments where GPF members are. And we will definitely avail ourselves to take your members through these reforms and how they are going to affect each one of us as members of the GPF, and what most importantly, your pension. We will be doing this presentation, and please note the following. What we are going to be presenting on is not a GEPF product. It is a bill proposed by National Treasury to affect all pension funds and provident funds. Please note that. So whatever we'll be presenting on, it is based on the proposal by National Treasury on how to reform the pension fund industry or the retirement industry. Lastly, on announcement, please note that this proposal or the bill has not been enacted or has not been put up on a government gazette by National Treasury. So whatever we're presenting now, there's a possibility that some of the things might change, or that some of the things might be improved on as the legislators in Cape Town are dealing with this law. Having said that, we can now start with our presentation. We all know that in terms of the background, that these proposals started in 2021 when we were faced by COVID-19, which led to slow economic activity, and most companies were being closed. And as a result of that, National Treasury made a call to suggest that because most people were facing economic hardship, would it not be prudent at that point to allow certain members or members of pension funds, especially those that are falling under the Pension Fund Act, to be able to access their benefits while still in service. And this announcement was made by the former Minister of Finance in February 2021. And from then on, whatever was suggested then kept on being refined. The proposed new structure at that point was called the two-pot retirement system, which intended to allow access for those who need money to survive and improve outcomes for members. National Treasury announced that this will only be applicable to funds governed by the Pension Fund Act. The point that I made earlier on, when this was initially done, it was only going to affect private pension funds. And as a result, you'd recall at that point in 2021, we issued out a statement where we were saying public servants will not be affected by these reforms because they were intended to be affecting those pension funds that are governed by the PFA. However, because of the engagements between the unions and the employers and government, GEPF at a later stage was then included to be part of these reforms. Subsequent to that, there were proposals that were made, that were sent for public comments, which then provided rationale on why these amendments were necessary. People were encouraged to make submissions to National Treasury on how they want this system to work once implemented. And that started on the 29th of July 2022, where the National Treasury released a draft revenue loss amendment bill. This was no longer only affecting PFA, as I had already indicated. So even the law that was supposed to be amended was then changed. It was no longer the revenue loss amendment bill, but the Taxation Act. And as a result of that, the GEPF then became included in what was being proposed at that point. We then, as required, provided our inputs into the amendments that were made in terms of outlining how, because remember, the GEPF is not a defined contribution fund. It is a defined benefit fund. Therefore, whatever was being suggested would then apply differently to a defined benefit fund like the GEPF. When the second draft was released last year in June, it therefore had to include all pension funds in the country. The National Treasury further called for public comments as part of consultation. The comments were closed last year in July. Now, what was then new on that was that the defined benefits fund were going to be included. However, different from defined contribution, the defined benefits were going to be based on service instead of contributions. Remember, What then becomes important is that in a defined contribution, you contribute a particular amount on a monthly basis, you have a separate account, and therefore it was easy for this system to be implemented there. Whereas in the GPF, as a defined benefit fund, you do not have a separate account. Your contributions, all members of the GPF, the more than 1.2 million members of the GPF, contribute on a monthly basis, and their contribution is put into one pot, which then made it difficult for the GPF to then say, if one is to access his or her benefits while in service, which system are we going to use to determine what has the person withdrawn? That is why then it became important that as a defined benefit, we will not use the contribution system, but we will use the pensionable service system to determine how much we have withdrawn and how do we offset that which we have withdrawn. As a result of that, the proposal was then almost accepted by all, and it was supposed to have been implemented on the 1st of March 2024. However, late last year, the legislators indicated that to allow the industry, the retirement fund industry, to be ready, that these proposals or these amendments will become effective as of the 1st of September 2024. So implementation is no longer in the next 2 months or so, or less than in the next 5 weeks. Implementation is going to be on the 1st of September 2024. Now, we first have to understand what the government is trying to address with these amendments. The first rationale is that the government realized that more often than not, when South African working class goes on retirement, they do not have enough saved for post-retirement life. You would recall that at some point we had public servants who will work for 10 years or so, then resign, take out their money, and then come in, especially in the education sector. So the implication of that was that most people, when they go on retirement, they would have spent all their benefits through that opting in and out of retirement funds. And by the time they reach retirement age, what used to happen is that in a very short space of time, a person will then have to join the social security sector through receiving social grants. The second part was that because of what we were going through in 2020 and 2021, most people were in financial distress, and as a result of that, government needed to provide some incentive for such people, that rather than waiting up to the point when you reach the retirement age, is it not possible for people to be able to access, because that is where most working class people are having savings in their retirement, in their pension funds. So as a result of that, we have explained this. And what also used to happen is that as people were resigning, government tried to introduce a very high tax on resignations as a deterrent for people to stop opting in and out and save adequately for their post-retirement life. However, this did not deter people. People continued in the education sector. They used to refer that as isdodla in KZN. And the last time when I was in Soshanguve doing a presentation at SADU, I was told that opting in and out is referred to as situba maboda, that people will do that in order for them to access their money and then go renovate their houses and so on. So in addressing these two rationale, the government has proposed this two-pot system to deal with this practice of opting in and out and not saving enough for retirement. So what these reforms, and please note this, what these reforms are trying to address is to promote preservation, that people need to save for retirement. That is the main rationale for this two-pot system, or for these pension reforms, that in the long run, all of us will have something to spend on post-retirement. There will no longer be a situation where a person can opt in and out. However, in understanding this, because there's a misconception out there that what then happens to what we have worked for up to before the implementation of this? Will I still be able to access my money? Will I still, when I resign, get whatever savings I have had before the implementation of this? We'll answer all those questions as we go with the presentation. Please stay on, do not leave. So what this reforms entails is the following, is that those who are affected will be allowed to access a small portion of their retirement savings. That's one. Two, that the savings or the preservation will be enforced such that in that pot, you will see the details as we go on. In that pot where you are saving for your retirement, you will not be able to access that which is in that pot until you reach the age of retirement. So hence, we are saying that component will be preserved. They will be kept until you are on the age of retirement. So this is how it's going to work internally in the GPF or in all pension funds, is that from the 1st of September 2024, any amount that you contribute to the GPF will then be divided into two. Example, say for instance, your monthly contribution, including your employer's contribution. Remember, in the GPF, you are contributing 7.5% of your monthly salary, and as a general public servant, your employer contributes 13%. And for those that are in the army, the police, and the intelligence community, the employer contributes 16% on top of their 7.5%. So that money, let's make an example that, say, for instance, you are contributing 1,000 rand. it means that 1,000 rand, a 333 of that 1,000 rand will then come into that pot, which is referred to as the savings pot. And the remaining amount, the 667 rand, will then go into your retirement pot. So from the illustrations of these two pots, you will realize that the savings pot does not have a lid. And the reason for that is that which you will be contributing into the savings pot, those 333 from that example we have made of 1,000, if your contribution is 1,000 rand a month, those savings, you will have access to them as and when you need them, but once a tax year, provided you have more than 2,000 rand or a 2,000 rand and more into that pot, into the savings pot. The retirement pot, where your 667 rand will be going out of that example we have made of 1,000 rand contribution, you will realize that that pot is closed, which means you will not be able to access that which is in that pot until you reach a retirement age. Moving on. So what then happens, maybe the question is, what happens to the money that I have worked for, say, since I started working up to the end of August 2024? Now, that money will then be put into what we refer to as a vested pot. That vested pot, it means for us who are currently working, different from a person who will start working from the 1st of September, we are going to be having 3 pots or 3 components to our pension fund. The first component will be the savings component. The second component will be the retirement component. And the third component, which is only applicable to those that are currently in service, will be the vested component. This vested component will not be affected by these new reforms. It will still be governed by the current rules. What does it mean? It means because you are currently in service and you have 3 components or 3 pots, should you resign now or should you resign after the 1st of September, you will still have access to your money that you have accumulated up to the end of August 2024. That money will be put in this vested pot, and should you resign, this pot will still be governed by the current rules, which means it will not say you will not get your money up until you reach 60 years or 65, as it may be. So please note that, because many people have started panicking and are being encouraged to resign before the implementation of these reforms, under the scarecrow that whatever they have worked for will not be accessible to them up until they reach the age of 60. It's a lie. Hence, these reforms have created a third component or a third pot for you to put all that you have worked for before the implementation of this reforms on the 1st of September 2024. So that which you have worked for will still be set aside, will still be governed by the current rules, which means If you resign, you will have access to your money. If you want to move it to any preservation fund, you will still have access to that. Moving on. Now, the question that may arise now is that because on the 1st of September, your savings pot will be empty and your retirement pot will be empty until we receive your September contribution. How am I going to access that which we were promised that we will access our pension? The current reforms are saying there will be a small portion of your vested pot, which is calculated at the 10% of your vested pot, or the 10% of what you have accumulated up to the end of August 2024, but not more than 30,000 rand. Effectively meaning that if you have 500,000 currently, by the end of August, you have 500,000, and the 10% of that 500,000 is 50,000. You will not be allowed to transfer from this vested pot to the savings pot 50,000 rand. You will only be allowed to transfer not more than 30,000. But example would be for a person who by the end of August 2024 will be having 100,000 in his or her vested pot. 10% of 100,000 is 10,000 rand, which therefore means that person can only transfer 10,000 rand, because that's 10% of what the person has in his or her vested pot, which is 100,000, and 10% of 100,000 is 10,000. But 10% of 500,000 is 50,000, and this person will not be able to transfer 50,000, but will only be able to transfer 30,000 into from the vested pot into the savings pot. These 10% and not more than 30,000 is what will be referred to as a seeding capital. You are seeding capital into your savings, which you will immediately have access to. So it therefore means come the 1st of September, all of us who are working will have money in our savings pot that has been transferred from our vested pot. And you do not have a choice whether you want money to be transferred from your vested pot to your savings pot. It will automatically be in your savings pot. The choice of whether you want to withdraw it or not depends entirely unto yourself. And this is as per that what I have just explained, that will all automatically be enrolled. You can't opt out. You can't say you don't want 10% or not more than 30,000 be transferred from your vested pot into your savings pot. Like I have indicated, once you withdraw from that vested pot into your savings pot and you access that money that is in your savings pot, it will affect your pensionable service. Please underline that. So when we go deeper into what we are saying, probably let's break it down into smaller pieces. So in your vested pot, Like I have explained, everything that you have worked for from the day you started working up to the 31st of August 2024 will go into your vested pot, and your vested pot will be governed by the current rules, not new rules that says you cannot access your pension until you reach the age of retirement. So even on that vested pot, when you resign, you will still be subjected to the current taxation rules. Remember, currently, when you resign, you have a tax rebate on your first 25,700 and the rest is taxed. Whereas when you retire, currently, before the implementation of these reforms, when you go on retirement, you have a tax exemption on your first R500,000. So these rules on taxation will still be applicable to this special component or pot for those who are currently in service. While we are here, please note that this presentation will be recorded and will be available in all social media platforms of the GPF. So if you have missed something or you want to read word for word or bullet for bullet on my slides, you will have that time to do that post this presentation. So the seed capital that we spoke about, we said is 10% and not more than 30,000 rand. It will automatically be transferred from your vested to your savings pot. And that which I've explained is at number 3, that it is determined as the lesser of a 10% of a member's interest in the fund as at the 1st of September 2024 and 30,000. Which then makes sense of why, if I have 500,000 or a million and 10% of a million is 100,000, why can't I get 100,000 into my savings pot as a seed capital? It is because it cannot be more than 30,000 rand. I have already made these examples about if you have 500,000, your 10% is 50,000, but you can only get transfer 30,000. And even with regard to this one, we have already dealt with this example of what happens if you have 100,000 in your vested pot. It means your 10% is 10,000. Therefore, you will not have 30,000 in your savings pot come the 1st of September 2024. And please note at this point, this transfer from a vested to the savings pot, it's a once-off exercise. It will not be repeated again, because the understanding is post 1st of September 2024, contributions, as I have already indicated, those 333 in that 1,000 rand example, will be going into your savings pot. And the 667 rand will be going into the retirement pot. So you only have one chance on the 1st of September towards that seed capital. It is not going to be an annual event. Into the savings pot, that's what I've just explained, that third will go into the savings pot. And the reason why you are allowed a seeding capital is because come the 1st of September, that savings pot will be empty. You will not be having any money into that savings pot. Hence, you are allowed to seed 10% or not more than 30,000. Now, note this. When you transfer from your vested pot, which is the money that you currently have up to the end of August 2024, to the savings pot, you will not be taxed. And the simple reason why you will not be taxed is because you transferring within the fund. You are not taking from the vested into your pocket. You taking from the vested into your savings pot. Therefore, there is no tax applicable. But note this, at a later stage, we are going to be talking about what then happens if you withdraw from the savings pot into your pocket. Into the savings pot, that is where your third of your contribution, a 1/3 of your contribution will be going into. And the amount that you can withdraw at any point or during each tax year should be at least a minimum of 2,000. There should at least be 2,000 rand. Say, for instance, you have withdrawn on the 1st of September. Come 1st of March next year, you want to withdraw, and in your savings pot, you have 1,000 rand. You will not be allowed to withdraw from your savings pot if it does not have at least a minimum of 2,000 rand. Now, because you'll only be allowed a once-off withdrawal from your savings pot once a year. Remember, the tax year runs from the 1st of March of each year up to the end of February. So you will have one access between 1st of March of each year to the end of February of each year, access to your savings pot. And as a result of that, different from when you transferred from your vested into your savings, when you withdraw from your savings, say for instance, that 30,000 that you will have on the 1st of September in your savings pot, it is taxable. It is taxable. From the savings pot into your pocket, tax is applicable. From your vested into your savings pot, no tax, because you are transferring within the funds. It is not a new it is not a new money, but it is money that has already been within the fund. Hence, you are not taxed when you seed that capital from the vested into your savings pot. Please, let's be clear about this so that I am not quoted to say, but Smanga Selemeni from the GEPF said, I will not be taxed when I withdraw from the savings pot. I said, no tax when you withdraw from the vested into the savings pot. So, and this amount will be taxed at the current retirement fund lump sum benefit scale. And unfortunately, I'm not a tax expert. You will have to consult your tax consultant or SARS to determine, say for instance, you need that 30,000 on the 1st of September. Please consult with SARS to check how much is going to be your tax on that 30,000. Because remember, we as individuals, our tax affairs are not the same. So tax will not be applicable the same way to all of us. And what then becomes important as well, remember, whatever you withdraw from your savings pot has got an implication on your pensionable service. So there is no free lunch. It's not a free money. It's money that comes out of your benefits. The more you withdraw, the more we reduce your pensionable service, with equivalence of what you have withdrawn. So what this two-pot system means is that you are borrowing from your future to satisfy your current needs. It is not a free money. So when you make that decision on whether you want to withdraw or you do not want to withdraw, please put this at the back of your mind, that whatever you are taking out of that savings pot, you will feel it when you go on retirement. So let this be a measure of the last resort when you need money, but you can't use it as if you will go and make debts and then want to pay your debts out of this money, and then come retirement when you are told, no, in actual fact, you do not have 20 years of pensionable service because you've been withdrawing. You now have 9 years of pensionable service. Now, on the retirement pot, which I have, say for instance, those 667 rand that I made example of for a person who's contributing 1,000 rand from the GEPF, you start contributing it from the 1st of September 2024. Say maybe in 2034, you are, for argument's sake, you are 45 years or you are 50 years. In 2034, you've been contributing in this retirement pot those 667 rand every month up to 2034. And at 2034, you are 50 years and you're thinking, I have had enough of waking up in the morning, going to work. I want to resign. You will not access those contributions that you have made into this retirement pot until you reach the age of 60. This is going to be more like your contributions towards retirement annuities. Those who've got retirement annuities will know that even if you lose your employment and so on, and you've been contributing towards retirement annuities in these private pension funds, you do not have access to those retirement annuities up until you reach the age of 55. In this case, whatever you have put into your retirement pot is not accessible until you reach the age of retirement. Please note that. However, like I said, because these reforms are still being refined, there was a suggestion that at least if you have in that retirement pot, you have less than 165,000 or up to 165,000, you should be able to access it even when you resign. So all those will become clearer once these proposals are gazetted and it is now law, and we all know. We will come back to update as to whether this amount stays up to 165 or not. So it means if you have 166,000 based on the current proposal in your retirement pot, that 166,000 will not be accessible to you until you reach the age of retirement, which is 60 in the case of the GPF. And should you immigrate and you resign here because you've got family outside of this country and you want to join your grandchildren out of this country, you will still not be able to access what is in that retirement pot for 3 years after you have immigrated. You'll only be able to access that on your 3rd year of having left South Africa. So let's also note that. And like I indicated, this pot ensures that all of us who are currently working, by the time we go on retirement, we must not rush to SASSA. We should still be having something to see us through our post-retirement life. Remember, when I first started, I said, this is the main reason of these reforms. It is not about you accessing. Access is by the way, but the primary reason for these reforms is to ensure that South Africans are saving for their post-retirement life. Because currently, as matters stands, only 6% of South African working class retire comfortably, having set aside something to lean on when on retirement. Now, as a form of a summary, we said, say if you are resigning currently, after the implementation of this new law or new reforms, you will have access to your vested pot. What is your vested pot? Your vested pot is what you have accumulated up to the 31st of August 2024. So if you resign, you will still access it, that which you have accumulated to date. If you resign, you will access what is in your savings pot. Those 1/3 contribution that you've been making will be accessible to you. But what is in the retirement pot, like I have indicated, will only be available to you when you retire. On retrenchment, say you are retrenched, you'll be able to access everything that is in those 3 pots. Because remember what I said, these reforms are called 2 pots or 2 component system. But for a person who's currently in the employment, you are going to have 3 pots or 3 components. So if you are retrenched, you'll have access to the vested pot, you'll have access to the savings pot, you'll have access to the retirement pot. If you are dismissed, because in the books of the GPF, dismissal, we treat dismissal like resignation. You'll only have access to what is in the vested pot, what is in the savings pot, and whatever is in the retirement pot, you will not be able to access until you reach the age of retirement. The withdrawals, these partial withdrawals, you will not be able to partially withdraw from a vested pot. Remember, from a vested pot, you only get a seeding capital. You put it in the savings pot. In the savings pot, you'll be able to access it provided it's got a minimum of a 2,000 Rand balance. Once every tax year, you will have access to it. But on the retirement pot, you will not be able to access it. So this will end that practice that I refer to as isdodla or situamabota, where people used to opt in and out of retirement funds in order for them to access what they have been saving for post-retirement life. On a divorce case, if you are going through a divorce and a divorce settlement says to the GPF, these two ex-spouses have agreed or will need to share, and please note this, there is a possibility that as a public servant, you can be in a divorce process and not necessarily touch your pension. Because I'm saying this because most public servants think that it is automatic that because you are married in community of property and therefore when you divorce, automatically you are entitled to a 50% of your ex-spouse's pension. It is not automatic. It needs to be explicitly clear on your divorce decree that as parties you have agreed, or as part of that court order, it is ordering the GPF to give your ex-spouse a portion. And that portion as well, when you agree to it, it must be clear from which point to which point. Because in other instances, it says 50%. And sometimes this 50%, you have only been married to this person for 2 years or 5 years of your 32 years service. So if it's just saying 50%, as the GPF will give your ex-spouse equivalence of your 16 years of your pensionable service. So it needs to be clear, what does this 50% mean from when to when? If you met her and you married her when you started working, it's well and good. 50% means 50 from the day one when I started working to currently. So please, when you are on those negotiations for divorce, pay attention to details, because at a later stage, you come back to us to say, but this person, I only married this person for 8 months, but he has received 16% of my pensionable service. Unfortunately, at that point, GPF cannot say anything because we are responding to a court order in a form of your divorce decree that says to us, we must give your spouse certain benefits out of your retirement benefits. So in that case, your spouse will have access to all those 3 pots. If it's 50%, she will have 50% of those 3 pots. Even when you are transferred, you'll have access to all those 3 pots and transfer those 3 pots to the next employer you are going to. And when you retire, when you reach retirement, out of your vested pot, it will be divided as per current rules. The current rule says when you go on retirement, a third of what you have accumulated comes in a form of a lump sum to you. If we go back to that example of 1 million, if you have 1 million in that vested pot, you will then have access to the 333,000, which is a third of 1 million. And the 667,000 will buy you monthly annuities. In your savings pot, when you go on retirement, whatever will be in that savings pot will add to your lump sum. But that which is in the retirement pot will only buy you retirement annuities or monthly annuities. So say for instance, you started working on the 1st of September 2024, you only have 2 pots. And when you go on retirement in when is now is 2024, in 2060, you only have these 2 pots, but you have withdrawn everything that was in the savings pot. Now you only left with money in your retirement pot. That retirement pot, you will not be able to get lump sum. Everything that is in that retirement pot for such a person, it will buy you monthly annuities. Because in terms of your contribution, they are already divided into 2. Your contributions, as I indicated, A third of that contribution goes into the savings pot. The 2/3 of that contribution goes into the retirement pot. Why in the vested pot are you getting two forms of payment if you have money in your vested pot? It is because the vested pot, like I indicated, will be governed by the current rules and pension laws, which are saying for a GPF person who is going on retirement, that person is entitled to two forms of payment: a gratuity in the form of a lump sum equals to a third, and monthly annuities for a period of 5 years, guaranteed for a period of 5 years, out of his or her 2/3. I hope I've made myself clear and not confuse you, because this table is intended to summarize everything that we have talked about. Now, the current page deals with the benefit structure. And this is exactly what I've just explained in the previous. Which law is applicable to which pot should you retire? So this also demystify the lie that come the 1st of September 2024, if I go on, I resign, I will not have access to my current money that I would have accumulated up to the 31st of August 2024. I think that is very, very important, because some unscrupulous financial advisors have made it their business to ill-advise GPF members in order for you to resign and take your money into their funds with all sorts of promises that are lies. Now, let's look at how are you going to claim for this. For those that can't wait for the 1st of September for them to access this 30,000 minus tax, how are you going to go about this process? We are currently discussing this claim process, and as the GPF, we feel that while other funds, which are easy to manage because they are a defined contribution, they know each of their member has got their own separate account where they are contributing and they are getting their contribution plus dividends. It will be easy for you to go directly to that scheme or that fund and make an application to withdraw from that savings pot. But for us, we thought about it. Remember, the whole idea is for you to have this money as and when you need it as fast as possible. We thought about it as the GPF. But we then said, if we are to allow you to walk into our offices to withdraw this money, remember, in terms of how we operate, whatever records that are in your employer are with your employer is what we have. Whatever records that are kept in your personnel file is what we have as the GPF. Therefore, we are unable to remove your HR section when you claim or when you partially withdraw from your savings pot. So we will maintain that process where if you want to withdraw, you first have to start with your HR section. Your HR section assists you to fill in the forms, and make necessary adjustment on your records and communicate to the GPF on your behalf. We would have liked that you come directly to us like with all other private funds, but unfortunately it's impossible, because remember, when you go on retirement, our records should talk to your personnel file, should talk to your employer's records. There cannot be discrepancies there, because those discrepancies are what usually leads to the GPF taking forever to pay out your claims. I've already, it will not be practical, or it might not. So, as and when we are refining this and we are getting used to it, we will engage with the employer to make it as hassle-free as possible, so that even going through your employer, because this is more like it's going to be money that you need when you are in emergencies. Therefore, it will still require us to also be agile and be able to pay you as soon as possible. But unfortunately, we can't short circuit going through or going via your employer for you to put up a claim for this. Now, what it means is that as we are deliberating on this internally, we are trying by all means to come up with ways and means to make sure that you will be able to access this money hassle-free as and when you want it. So it will require all sorts of things for us to make processing of this claim much faster than your normal claim that normally takes up to 60 days to be paid in terms of the law currently. I think we'll have to end up here. However, these practical examples that you will see here are intended to just inform you and make you aware of what are the implications should you want to withdraw, and whether or not is it advisable to withdraw. When you withdraw, are you aware of the implications? So I will just share them with you quick. The first one deals with a comparison between a person who will withdraw on the 1st of September immediately out of excitement, and a person who will withdraw at a later stage, 3, 4, 5, 2 years, a year down the line, due to a certain emergency. And these people have got the same pensionable service, and what it does when a person goes on retirement. And these examples, these numbers, just indicate, all what it indicates is that, if I have to summarize what these numbers are saying, is that the earlier you withdraw, the more impact it will have on you at a later stage when you go on retirement. The later you withdraw, the better, because you will not be affected similarly, like a person who withdrew early vis-a-vis a person who withdraws. Because whatever you withdraw now, you must also be able to calculate it over a period of time. This 30,000 over a period of 10 years, how much will it have been if I did not withdraw it vis-a-vis that I have withdrawn it? You must be able to make that maths, because all what it means, you could be withdrawing 30,000 on the 1st of September 2024, and you're about to go on retirement in the next 10 years, and you only realize in 2034 that 30,000 minus tax that you withdrew in 2024 could have been an additional 150,000 on your pension in future. So be aware of that, and at your own leisure, you will go through these examples and consider whether or not it's advisable to just withdraw for the sake of withdrawing, and even if you don't need that money, because the example that I normally make is that you will withdraw because you've got a Shibin debt, and you want to clear all your Shibin debt, and then you are able to clear that Shibin debt, and only to realize when you go on retirement that in actual fact, that was not the 30,000 that I withdraw. I have withdrawn 150,000 out of my pension to deal with my babalas, and now I have to suffer the consequences because I was just excited that I have access to my pension. I can withdraw it at any point, and in the long run, you realize that you have borrowed from your future, and now you are suffering the consequences of that ill decision that you made at that point. For instance, if you follow those examples, you'll realize that a person who withdrew early, their benefits when they go on retirement would have been 22% lower. So it's not only the 30,000 that you see, or a 30,000 minus tax that you see. It's got a long-term implications on your retirement bottom line. So when you make this decision, it must be informed and not necessarily just out of I'm broke, I need money, and you go withdraw and you cry at a later stage. You even see on this example, the second example of Clever Brick and Wise, the bottom line of what they would have withdrawn is depicted here in terms of what it does to their gratuity and pension. And then you realize that because Clever withdrew late and Thabo withdrew early, Thabo gets a 14% lower, while Clever receive his pension benefits at retirement are 19% higher than what Thabo gets. So all what these examples are saying to you is that there are implications when you withdraw, and those implications you are only going to feel them when you go on retirement. Therefore, when you withdraw and use whatever you have withdrawn wisely, so that you do not at a later stage regret. Unfortunately, I won't be able to take live questions here. Let me just check on my chat board which questions have you been posing, and see if I cannot respond to a few, while we have agreed that in terms of the rules of engagement, you will continue asking questions, whatever questions you have, and we will respond on our Facebook page. I understand Mr. Varas Singh is saying, I understand your explanation on resignation payouts, but I'm still not sure of your explanation. That's the way you understand it. It is not clear in the legend. When will the wedding confirm this? I'm not sure what he is saying, but if it's about what happens when you resign after the 1st of September, because you are currently in service, you have three components to your pension. It's savings, it's retirement, it's vested. The vested component, which is what you currently have, and up to the end of August 2024, is governed by the current rules, and therefore, if you resign, you'll have access to it. In terms of adding money, this has not been clarified in the current proposal, whether you will be able to add, or maybe I withdraw 30,000 in September, and at a later stage, I've got money, I want to return the 30,000. It has not been provided for that part. So for now, we will not be able to speculate until the law has become clear. However, what I can advise is that part of new reforms in the GPF is that we are introducing an additional voluntary contribution scheme. At the next time when we speak, I will explain what does that AVC means. It means mandatory, you are required to contribute 7.5% of your salary on a monthly basis. The employer contributes 13%. But if you want to contribute more, the GPF systems are going to be built in such a way that you can contribute more. That is that AVC that I was talking about. It is a proposal or a resolution of the Public Service Coordinating Bargaining Council, where your unions sit. They made this resolution in 2017. GPF is working on it in order to operationalize that part. But until then, the current reforms that we are talking about on two-pot system are not explicit about whether or not can you return what you have withdrawn. Now that you have won lotto, you want to return the 30,000. It is not provided for in the current situation. If you resign now before the two-pot, I have said this, even post-implementation, you will still be able to access this that you have worked for. I think it's about Ruxana Jacobs. Access to your vested pot is available now or post-implementation, because you'll be having three pots. The only pot that you will not be able to access, we said, is the retirement pot or the retirement component. Go back to that summary, the table summary that I have made. It will answer that question. Mr. Varas, or is it Mr. or Miss? I am not part of government. I am part of the GEPF. I do not deal with legislation. The legislation is dealt with in Cape Town by the legislators. So I do not know when this legislation is going to be gazetted. As the GPF, once it is gazetted, we will have no choice but to implement the law as it will be then. So unfortunately, I do not have control of this. This is a national treasury process. Any questions around when are they going to legislate or gazette it, please refer them to the national treasury. We are just implementers of what was proposed by government. And this is not only applicable to the GPF, it is applicable to all pension funds. Hope our benefit statement amounts will not be less after. Can we have a guarantee? Your benefit statement is going to change, because your benefit statement, thanks for this question, your benefit statement is going to have to reflect, currently it reflects 4 things. The new benefit statement after the implementation will have to change in the sense that it will show you how much you have in your savings, how much you have in your retirement component, how much you have in your vested component, what have you withdrawn. So those are things that are happening back office, which we are currently dealing with in order for us to be ready. But rest assured, once they have been finalized, you'll be the first to know, because you need to be able to interpret your own benefit statement when you look at it. Anna Maine, my presentation is not audible. Is that the feeling of everybody? I thought I have been audible throughout. Unfortunately, if I was not, please go back to the recordings on all our social media platforms, or invite us to your employer with a group of your fellow colleagues or a group of your fellow comrades in your unions. We are available to come sit down with you, go through this presentation, deal with all questions that you may have. This platform is intended for those that may not necessarily have a chance, but at least they have received the message. They will assist the GPF to spread the message. Should you have a question, you will then consult with what is contained in this presentation, or you will invite us. We have sent this information to all your employers and your public service unions to say we are available to come and explain, so that before implementation, you are clear about how this is going to affect you. Deep notation, please go back to the recordings. Everything has been explained there, though you have just entered, joined the chat. Just go back to the presentation. It will give you all that information. Whereas there's not going to be any reduction to your benefits amount. If you do not withdraw, there's no reason why your benefits amount should reduce, because the current rules are saying your pension fund in the GPF grow twice a year. It grows when you add a new year of pensionable service. It grows when you receive a salary increase or a promotion. So those will still be applicable to your pension. They will not change. The formula that we use to calculate your benefits is not going to change. So there won't be any reduction unless it is a reduction caused by you withdrawing from the savings pot, because whatever you withdraw there, we must account for it in terms of your pensionable service. Yeah, this recording is available on the GEPF Facebook page and all social media platforms. And Shana Jacobs, unfortunately, I have explained, this is a government proposal. All pension funds, including private pension funds, have to implement. Therefore, whether you like it or not, you can't pick and choose which component you want to implement. As a pension fund, you are going to implement 2 pots for new employees and 3 pots for those that are currently in service, to account for all what I have explained. It is not a choice. If it was a choice, I think GPF was not going to be a party to this, because it is more cumbersome for the GPF than for pension funds that are governed by Pension Fund Act, which makes them easy, or pension funds that are using the system of defined contribution. This is going to be easy for them. They know Miss Jacobs have contributed 10,000 rand and she wants 5,000. They give you 5,000. You are left with 5,000 with them. Come the end of the year, you get dividends on 5,000 and not on 10,000 because you have already withdrawn a 5,000 of that 10,000. But with us, what makes it difficult is that what you get as benefits from the GPF is not calculated in that way. It is not your contributions that we are accumulating. You actually are contributing much lesser than the benefits that you receive at the end, because the system that we use, or the formula that we use, we only look, when you go on retirement, we only look at how many years have you been contributing to the GPF, at which salary are you in your last 2 years of service, and then we are able to determine your benefits. It's not applicable. No, it will not be applicable to you because you are a pensioner, Carlo. And then Pakamisile says, yes, you will. I don't know what is you. Sondo, about whether or not there are exclusions, go consult with what is contained in that proposal by the National Treasury and look at exclusions. I am not sure whether there are exclusions. All what I know is that come the 1st of September, everyone is going to be affected the same. What will differentiate us is whether or not have we withdrawn or not withdrawn, and at which point did we withdraw, and so on. Unfortunately, I do not work for SARS. I don't know the tax implications of this. I have tried to explain them as I understood them as contained in the proposal. Obviously, the more you withdraw, the more you are taxed. It adds on the tax, that because this is going to be an additional income on your salary. So if you are taxed, say for instance, you are taxed at 36%, and on that month you are getting an extra 30,000, it means your tax will go up. Your nominal tax will go up because you are having, it's like when you get your bonus and your bonus is added to your salary, obviously your tax goes up, and this is going to be the same implication on your tax matters. If you do not withdraw from your savings, you need not worry, because then at the end, when you go on retirement, everything will still be intact. Nothing will affect your pensionable service, and your pension would have grown, as you have seen with that example. Those who withdraw get less benefits. Those who have never withdrawn get more benefits. That's the principle. Lastly, Gail Smith was just confirming that I'm audible. And then Malema Violet Jazz is asking when the proposal. Please go back to the presentation. It will explain. Thank you very much. Having dealt with all the questions that was on my chart, this is not the end of our discussion on this issue. This issue keeps on changing, and it is all a new animal to all of us. So as and when you know something, bounce it with us. We will be able to answer you, because like I said, what happens in the defined contribution funds will not necessarily be the same as what happens in your pension fund, the GPF, which is a defined benefit fund. So do not take whoever explain it to you, his word for it. Consult extensively until you have understood. Don't be emotional when you're dealing with this. It's a very emotive issue. It deals with your money, we understand, but Don't make a mistake of those in 2008 who misinterpreted the reforms that were being introduced then and resigned en masse. And now, currently, we all know what happened to them. Most of them were teachers and nurses. They are now at post level 1, trying to work their way up again. Secondly, most of them are now replacement teachers, as and when their colleagues are going on maternity leave, they get to be employed. They are temporary teachers, and so on. So let's not make that mistake. We are deliberately communicating this early, having learned in 2008 the mistake that most public servants made. So please be on the alert. Don't fall for any lie. This information is available on National Treasury website. If you require GPF to assist, we are available to assist. Thank you very much. God bless.